Insurance companies in 1906 had a problem. The fire that burned San Francisco wasn't supposed to happen, and their contracts didn't account for what actually destroyed the city. April 18, 1906, 5:12 in the morning, the earth moved. A rupture opened along the San Andreas Fault running 296 miles through Northern California. The initial quake lasted between 45 and 60 seconds. Most buildings that would collapse did so in those first minutes, but the fire was still hours away. By 8 a.m., fires had ignited in at least a dozen locations across the city. Broken gas lines, overturned stoves, ruptured chimneys. The fire department had a single advantage: they knew how to fight fires. What they didn't know was that the quake had fractured the water mains. Hydrants ran dry. The advantage disappeared within hours. The fire burned for 3 days. It consumed 28,000 buildings. It destroyed 500 city blocks. The death toll reached 700, though some estimates placed it higher. But here's what mattered to the insurance industry: almost every building that burned had been insured. The claims would be enormous, and the insurers faced a question that hadn't been settled in law. The question was simple in words, impossible in practice. Did the earthquake cause the fire, or did the fire cause the destruction? This wasn't semantics, it was the hinge on which every insurance contract swung. Most fire insurance policies of the era included an earthquake exclusion, but if the fire, not the earthquake, caused the damage, the insurer had to pay. The insurers at the time didn't have clarity. Their contracts were written for a simpler world. A fire starts, you pay the claim; an earthquake hits, you don't. But in San Francisco, both had happened, and the sequence mattered legally. Policyholders argued the fire had done the damage. Insurers argued the quake had made the fire inevitable. The courts had to decide, and what they decided reshaped insurance forever. The ruling came down to causation. If the earthquake caused the fire, no payment. If the fire caused the loss, independent of earthquake damage, payment. But in most cases, both were true simultaneously. The court split the difference. Insurance companies paid out. The total reached around $235 million in 1906. That was catastrophic. Some insurers went bankrupt. Foreign insurance companies, especially German and British firms, had written policies across the American West. They faced ruin. The entire industry had been tested and found unprepared. But something shifted after those payouts. Insurers didn't retreat. Instead, they refined their language. The exclusions became more precise. Earthquake was now explicitly defined. Fire caused by earthquake was carved out separately from fire coinciding with earthquake. They were learning to write contracts that could survive catastrophe. By 1908, earthquake insurance began to emerge as a separate product. It was expensive, it was limited, but it existed. The market had identified a gap and filled it. San Francisco had inadvertently written the rulebook for how the insurance industry would handle natural disasters for the next century. The rebuilding itself followed a pattern. The city didn't rebuild randomly, it rebuilt with new building codes. Brick and stone replaced wood, wider streets were mandated, fire breaks were engineered into the urban plan. The physical city became a contract, a bet that better design meant better protection. Insurance companies had a stake in that rebuilding. They couldn't afford another 1906, so they began hiring engineers. They began inspecting properties. They began charging premiums based on risk factors: building material, proximity to water, street width, fire department response time. They were quantifying risk before they had the math to do it. This is where the modern insurance industry was born, not from success but from spectacular failure. The 1906 earthquake and fire had exposed the weakness in contracts written without catastrophic scenarios in mind. The industry's response wasn't to hide from risk, it was to price it. But there was a cost to those policyholders rebuilding their lives. Insurance premiums rose, coverage became more restricted, the exclusions multiplied. What had been a simple contract pay for fire damage became a labyrinth of conditions, riders, and carve-outs. Protection became more expensive because the industry had learned what it cost to be unprepared. The San Francisco rebuilding also established a precedent for how disaster recovery would be financed. Insurance paid for much of it, yes, but the city itself had to mobilize capital. Bonds were issued. Federal assistance, though minimal by modern standards, was requested. The pattern of sharing catastrophic risk across insurance, government, and private investment took shape. What's crucial to understand is that the people making these decisions didn't know if their choices would work. They were writing contracts and building codes without historical data on earthquakes. They were guessing at risk premiums. They were inventing actuarial science in real time under pressure, with billions of dollars at stake. And they mostly got it right. The insurance mechanisms that emerged from 1906 held. The building codes prevented worse damage in subsequent quakes. The system of distributed risk spread across insurers, across policyholders, across time created stability. It wasn't perfect, but it worked better than the alternative: no system at all. Today, when you read an insurance policy, the language is dense and precise because of 1906. The exclusions are specific because insurers learned they couldn't afford ambiguity. The premiums vary by location and risk factor because the industry learned to price catastrophe. Every clause, every rider, every exception has a history, and much of that history runs back to one earthquake, 3 days of fire, and a city that had to rebuild itself. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe to see how catastrophes rewrote the rules of risk across finance, infrastructure, and law. New videos every 2 weeks. This video is for educational and informational purposes only and is not financial advice. Always do your own research.